to episode 47 of Top of Mind with Consilio Wealth. Today is April 19th, 9:56 in the morning. It is Friday, a beautiful Friday here, coming to you live and in color. Hao and I are back to chat about some fun stuff in the markets here in the last couple of weeks. First and foremost, we wanted to discuss past period of market ups, just like what we all experienced since Halloween. And is this normal or is this not normal? Number two, gold. It's not as shiny as you might think. We've got some data on historical returns on gold and also what might be supporting gold's prices right now. Number three, S&P 500 companies are likely to continue to report very strong earnings growth for Q1. This is data from FactSet that came out. I think that's good news generally. And finally, the 10 best performing stocks year to date. Can you guess what they are? I bet you can't. They're not what you think. All right. How are things today?
Going great. Sunny in California, as always. So we're experiencing a really nice spring.
Not to brag, it's sunny as always. That's great. Well, it's sunny in Seattle too. So how about that?
Yeah, can't complain. Again, we were up there, Chris and I, up there a week ago. Beautiful weather. So hopefully things turn around in terms of consistent sunshine for you guys.
We just had so we get together quarterly as a team to discuss business objectives and just how we're doing as a firm, and also, constantly trying to iterate on the services and whatnot that we do for our clients. We get together twice a year, so many of our clients know that we are a fully remote firm, and our team is spread out across the U.S. So we fly everybody in twice a year and do that meeting in person. We also do some other team building activities and just have some fun and chat with each other. We went to Suncadia last week. Last week?
Yeah, last week.
Wow.
Yep.
And it was a great time getting everybody together. And we got some beautiful weather out there. So that's what Hao's talking about. All right, let's dive in. So past period of market ups. We just experienced a pretty big run in the S&P and really just the market in general across all asset classes in the last 6 months or so. What we thought we would do is unpack that a little bit to just discuss, is this normal? Is this not normal? And just what to expect. So I'll start with a little bit of data and then how I want to kick it over to you. So the S&P so far in 2024 has notched 22 all-time highs. That's not that crazy. Many of you may have seen my LinkedIn post a couple of weeks ago where markets generally spend 50% of their time within 5% of their all-time high. So once they hit an all-time high, they kind of keep notching all-time highs. So the S&P has notched 22 of those so far this year. More than 25% of those have been in the past 5 months. What is even more impressive, however, is the S&P has not gone through a big pullback in a long time. So it's in fact been more than a year since anyone has seen a greater than 2% decline day. And that is the sixth longest streak since 1965. Interesting. And so far this year, those that follow the analysts that predict markets, and they always say that markets are up a little bit every year because that's what analysts do, the market has already beat pretty much what everybody has said for the entire year just in the first quarter alone. So, Hao, I know you've got some interesting insights here on just this data, but what's your take on all of this?
Yeah, I did the math real quick and looking at it a different way. It's 10% of the time where we get a stretch like this. Going back to 1965 to have a, by Goldman's count, 280-day streak without 2% sell-off from her, pretty rare. But that's why we say, hey, get invested and stay invested, because who would have predicted this kind of a streak? Maybe this could be a part of a new regime where there's constant buyers with the advent of 401k, things like that. When people get paid, that's like new reinvestment coming in every 2 weeks or every month, depending on pay cycles. So I think getting a streak like this shouldn't surprise people because it does happen, but it is relatively rare. Going back those 60 years, it's just something we probably don't expect because there's always something happening, right? There's always something to give you reason to pause. And I think the questions we've been seeing is, well, the market's at all-time highs. Should I wait? Wait for what? Like, what are we waiting for? Because as Chris says, markets will generally hover around all-time highs because the economy expands, right? Companies are making more and more money, and each quarter when they report their earnings, guess what? They report higher earnings. They make more and more money, even in the high inflation environment. That companies have been generally much, much healthier prior to this high inflation regime that we're facing.
We'll get into this a little bit in one of our later segments we have some FactSet data with earnings, but yeah, you're right. Earnings generally grows.
I spoiled like the next three topics, didn't I?
No, that's okay. I think that's great. Earnings generally grows, which is what you're buying when you buy a share of stock. You're buying a portion of those earnings, and you're betting on the fact that those earnings will continue to expand over time.
Yeah.
Yeah. Go ahead.
Yeah, and going back to that chart that we're verbally explaining, the average period of this type of stretch where there's no sell-offs in a single day that are 2% or more, it's about 29 days or 29 trading days. And that's actually pretty more normal than what we're experiencing now. Mm-hmm. And again, Chris and I are talking in the middle of April, where April has been a pretty bad month in terms of a small sell-off, but no single day has been more than 2%. And that's both for the S&P and the NASDAQ. And typically, we've always said this, year in, year out, investors should brace for a total of negative 10% drawdown on average, at the very least. Mm-hmm. And some severe ones are, they do happen once every few years, but they do happen.
So I mentioned that we're on the sixth longest streak since 1965. So you said the average is market goes up 29 days, and then there's a
2% sell-off.
Maybe not up 29 days, but for 29 days, and then there's a 2% sell-off. So the average is, let's call it 30. We're currently at 280. That's actually still on the low end of this longest streak. So it is the sixth longest streak. The 5 other periods are 315 days, 352 days, 527 days, 748 days, and 950 days. 950 days without a 2% pullback? That's crazy. I want to highlight those last two because I think that our listeners might think this is interesting. The 950-day period, and that is trading days, without a 2% pullback, ended in 2007. The 748-day period without a 2% or more pullback ended in 1986. So kind of the two very strong markets that then led up. That was probably the crash of 87.
It was.
Is probably what was a greater than 2% pullback. And then obviously, 07, 08, 09, everything the wheels came off then. So we'll see if we make it to the 1993 prior record, which was 315 days. But we're currently at about 280 as of a couple weeks ago.
Yeah, and I think there's a strong likelihood we could reach that. I know there's things going on with the Middle East, China, you name it. But we've had those geopolitical issues in 2007, in 1986. This is not new territory that we're venturing into.
I just pulled up just checking markets here quick, and they bounced. Things were going down. I think the NASDAQ was down like 1.8 or so, but everything's bounced so far in the last like 30 minutes. So yeah. All right, let's move to gold. Gold is not as shiny as one might think. So why is this coming up? So gold's been going up in recent times here, and so we thought we would unpack why and just what's going on in that market. So last week, this is the week before last, Gold broke above 2,300 an ounce for the first time ever. And gold prices have been climbing for a number of reasons that we'll get into. What is interesting here on this chart that I'll kind of unpack here is that gold since 58 or 68? Since, let me zoom in on this chart here. 88. Totally wrong. Glad I zoomed in. Okay. Okay.
Just a few decades off.
Yeah, just a few decades off. See, that's why we got to zoom in. Okay, so gold since 1988 has returned 4.5%. Compare that to the S&P 500 at 11%, and compare that to the MSCI World, which is kind of like a world index, at 8.2%. However, the volatility, so the bounce across all of these three different areas of the market, has been basically the same, right around 15% for all of them. So gold investors or gold owners have endured the same amount of volatility as buying the S&P 500, but they've gotten less than half the return. So, Hal, I want to turn it over to you. What's going on with gold prices recently, and what do you think is influencing the short-term price appreciation?
Yeah, and I think someone's going to correct us. As of today, gold's trading above 2,400. So, just a week, past the gold has continuous charge. I think what's driving this, we got to look at who the buyers are. And Chris has a funny anecdote about, not funny, I guess, people going to Costco and they're buying the physical gold bars, which has been in high demand. But the biggest institutional buyers of gold are central banks, namely China's bank, or the Bank of China, where they are shoring up or potentially hedging for catastrophe in their local economy. But you go beyond China, the next biggest buyers are other central banks. So in terms of the gold performance recently, it's really driven by sovereign states. And when I mention central banks, I'm talking trillions of dollars worth of potential buys. That is really pushing the gold price. It's really not Costco demand or ETF gold demand here in the States by retail traders. They just don't have that much dollars to push the metal up the way it's been going.
I think the key understanding here is that unlike when you go buy a stock, which again is a share of a company that is anchored by earnings, or if you buy a bond from a company that is paying income and anchored by the assets of that company, gold is purely a speculative market, and so the prices move based on the underlying value or speculation of that asset. So it's a completely different market than buying a share of the S&P or buying a share of Costco or whatever. Speaking of Costco, they are estimated to be selling between 1 and 200 million monthly in these gold bars. You can buy them right on their website, and they do limit them. Of course, it's members only, but they limit them. I think it's 2 per member.
And they still sell out.
They sell out every time. They sell out super quick. So kind of an interesting thing that's going on right now. There's just a lot of gold demand. And also, just when things are going on geopolitically, sometimes that will drive more bearish investors into hard assets, because there might be some belief there that that gold could be traded and monetized at a bigger rate down the road. So there's always, go ahead.
I think your thesis really matters here, and you should backtest that. Like, if gold's like that bad news hedge or the catastrophe hedge, you just got to look back to COVID, where gold sold off by 12%. So something that's supposed to be a hedge sold off. It didn't hedge. It didn't rebound while COVID was happening. It did rebound, but it rebounded with the market and the subsequent reopening of the economy. So it didn't do its job then. And as an inflation hedge, also in 2022, when we saw a lot of 2021, to be fair, we saw a lot of high inflation readings. Again, gold peaked around. Let me just change this level. peaked in March 2022 and subsequently sold off by 10% during the year of 2022 when inflation
What did it peak
was
at?
its peak. I had the wrong metric up. Let me just pull it up quick. I know this makes for a really compelling
Yeah, I
listening
just
here.
can't wait for the answer. This is good.
All right. And it's not giving me, it's an index that I'm looking at here.
Oh, it's an index. Okay.
Yeah.
Well,
But I think the rationale behind it works because if you're buying because things are bad, you got to look at how it responded when things were bad in history. To Chris's point, it does carry market risk, but doesn't give market rewards. And our investment thesis is that's just not a good diversifier. It's not a good investment. It doesn't pay to hold, like it doesn't pay a dividend or any
Right.
income. So,
in fact, it costs to hold because you got to store it and it has
Yeah.
value, and you got to pay a bunch of people to stand outside the doors with armed guards and put it in a vault, and
Yeah.
so there's a lot of cost in holding that asset too.
and for tax reasons, right? If you're holding the wrong type of vehicle, you're most likely paying a K1. Even if it's in an IRA, you're not getting the full benefit of like a hedge. There's lots of reasons to find fault with the gold investment as your only, buy in case things go bad type of investment.
Yeah. So for context, we don't buy gold directly in our portfolios for clients. It's a speculative trade that will move at sort of unpredictable times. As Howe's pointing out, it doesn't seem to be the for sure. Oh, it's an inflation hedge. Like it's actually a really bad inflation hedge, or when like a doomsday hedge, it doesn't seem to work really well there too. So it has to be timed perfectly in order to catch the low and sell the high. And just fundamentally, we don't believe in that level of market timing, and would recommend diversifying elsewhere. By the way, all these Costco people buying $100 to $200 million a month in gold bars, are they like storing it somewhere? Are they like, that's a lot of gold, right? Do you somebody that's bought a gold bar for $2,200, is that just like hanging out under the couch? Are people putting it in safe deposit boxes, which come with a monthly cost, unless certain banking relationships, of certain size will then give you a free safe deposit box, whatever. Like, that's an interesting conundrum, right? There's hundreds of millions of dollars of gold now sitting in U.S. homes. That wasn't there before.
Yeah, there's a cost of storage, right? If you're not paying the monthly safe deposit box subscription or whatever the membership fee is, you're buying a safe most likely, because I'm not leaving it out on my countertop. It's gold. It's gold. There's value to it.
It's worth $2,300 right now.
And
$2,400 right now.
And the flip side, I didn't check the secondary market for Costco gold bars, but it most likely would trade within the range of the $2,400
Sure.
per ounce, right?
Yeah.
So you're not, getting Taylor Swift type of scalper money off this. You're whoever's going to be buying for it, because it's a pretty thin market relative to the stock market. So you got to find a buyer who's going to physically come to your house, or how you're going to physically ship your sale over to this person, right? So there's a lot to consider when you're buying something like this. As a novelty, yeah, go ahead and buy a $2,000 brick or whatever Costco charges for it. But you see what I mean? If it's an investment or a safe haven asset, to benefit from that, you would need to sell it when times go bad.
Has anyone ever tried to sell a gold bar? If anybody out there listening has tried to sell a gold bar, please email us and tell us exactly how you did it and what you paid to sell it. I'm sure there's a commission on it, right?
Yeah.
You're probably going into like a rare coins store or that type of thing, a metals store,
Or a pawn
and you're selling
shop?
it.
When did you get
maybe
100%
pawn
of
shop.
your perceived value selling
Yeah.
anything at a pawn shop? I bet they're
Right?
giving you 50 cents on the dollar.
I don't think it's 50 cents on the dollar, but I think it's some sort of a commission.
Yeah.
But then, they ultimately have to
Turn around and
sell
sell
it
it.
as well.
Yeah.
If they're going to give you cash, they need to sell it and then get their cash, and, they
Correct.
have a business. They have to make make a turn on that. That's interesting. If anybody has ever sold a gold bar, please tell us how you did it. We don't need your address or anything, but how did you do it, and what did you pay to do it, and what was the price that you got? Was this one of these, like, when you land in a foreign country and you get through the airport and it says like no like free money transfers because the rate's terrible. They don't like charge you a fee to exchange your dollars into, say, pesos. It's like the exchange rate's horrible, but it's free. Like, was it one of those types of scenarios, or was it actually like a commission that you paid, or how did it work?
Yeah, and if you're using it as jewelry, how are you smelting it? I really don't get the appeal in the modern times for the physical gold. I kind of get the investment side of it, but not I'm going to buy
the allure
it.
At least.
Yeah, buy it and store it.
All right, let's move on. So, according to FactSet, S&P 500 companies will likely report year-over-year earnings growth of at least 7% for Q1. I thought this was pretty good to see this in there, that many companies are growing and that most companies are projected over the 7%. How you had a different take on this, I think. And so why don't you share with our listeners what are your insights on this?
Yeah, so the market prices, let's say Netflix, for example, right? What are Netflix prospects for the next 6 months to a year? Right, the market prices in...
According to their earnings today.
Yeah, bad example. Down 8%.
Bad example. Yeah. Next example.
but that's a good example where, Netflix is no longer going to report on subscriber growth or lack thereof, even though they grew subscribers by quite a few million. They're going to report on bottom line, right? How are they operating as a functioning company? That was met with expectations that subscriber growth might have apexed, therefore it's going to go down or flatten out. So that expectation will most likely have to shift towards counting the number of new subscribers to how much money are they actually making after paying out all their costs, right? That future date, what's being priced in today, right? No one knows the future, but if Netflix has a blowout earnings in July, they're most likely, the stock's going to go higher. That's kind of what happens when expectations are set to a certain point and the company overshoots them. It's not because the expectations are infallible. They get it wrong all the time. That's why you do see 20% up for Meta in January.
That's
right?
wild, yeah.
Or when you see a negative 8% in Netflix today. Because those types of swings happen because expectations aren't meeting up with reality or aren't lining up with reality. And I think what FactSet is uncovering is expectations heading into this quarter's earnings are about 7% below what is actually happening. I know forward guidance does play into that because, yes, I'm investing in a company because it's future prospects, not because of what it's done. But the component of being able to meet expectations is a huge, huge part of market reaction, right? Because expectations aren't priced in. There's really no market movement, right? Because you're just pricing in what is coming in already, if that makes sense. Where if McDonald's makes $1, I know I can invest McDonald's at $1 profit plus any premiums I'm expecting to pay. But the premiums, the component of premiums is based on future earnings. So if McDonald's makes $1, I'm investing $1 in McDonald's without any expectation of the future, which we suddenly don't have a stock market. But it's wild that the expectations market-wide seem to consistently be undershot because this quarter is not an anomaly. The market expectations tend to be below what S&P companies are capable of printing, right? They've been very good in growing their bottom line, even in an inflationary environment or even sometimes in a recessionary environment. It's pretty rare when S&P companies undershoot expectations. It does happen, but that's because something broader or unforeseen is hitting the market or the economy in a broad sense.
And that's kind of what I as we dug into this, I thought was interesting. So, the title or the headline is S&P 500 companies will likely report year-over-year earnings growth of at least 7% for Q1. What you promptly pointed out to me is over the past 10 years, actual earnings reported by S&P 500 companies have been 6.7%. It's the same, right? So, the headline's like, oh, it's really good, but it's actually kind of the same as the 10-year average. During this period, 74% of the companies in the S&P have reported actual earnings per share above the estimates. And so it goes on to say that the kind of sandbagging that companies tend to do, then they beat earnings, then also the estimates, maths out to about an 8.9% earnings growth for the quarter. We'll see what it actually is when everybody announces, but I thought it's basically on trend, which I think is good news, by the way. It's good news that it's on trend.
Yeah.
But it wasn't so good as it might seem. It's along trend with the average.
Yeah, and I think that's kind of the same song and dance we've been playing for the last 10 years.
Yeah. Well, that's what I would suggest.
So that's why investing at highs just shouldn't really shock people, because you see an expensive market today. Tomorrow could mean the companies are living up to those expensive expectations, right? Look at NVIDIA. They were expensive. Believe it or not, their share price has gone up, but their earnings have grown faster than their premiums have, meaning NVIDIA, objectively has gotten significantly cheaper, relatively speaking, in terms of the amount of premium you're paying to profits. Which
is wild. Yeah.
It's wild, yeah.
All right, let's move on to the 10 best performing stocks. They're not what you think. Speaking of NVIDIA, you might be able to guess one of the best performing stocks.
Year to date.
In fact,
right.
Thank you. Year to date. And this is as of April 2nd, so a couple of weeks ago. Yes, you all are correct. NVIDIA is one of the best performing stocks as of April 2nd. In fact, it's the second best performing stock. But can you guess the best performing stock?
And
nobody. Okay.
This is for the S&P companies, I'm guessing,
this is
right?
for the S&P. So it's a company called Vistra. I don't know what they do. How do you know what they do?
They're a utility company. I had to look this up. So
they're a utility company.
In prepping for this, they produce nuclear energy. They're in Texas. They produce nuclear energy and most likely benefited from increase in natural gas prices. Also do solar power and coal. So anything that you plug in for electricity, they're most likely a provider for it. In Texas, I don't know who they serve, but it shows how some of the under the radar companies quietly outperform some of the biggest headliners.
And next one's NVIDIA. What's the next one? We had to look this one up before we hit record.
Yeah,
has anybody ever heard of AppLovin?
And this one reminded me of that Seth Rogen movie where the character was named McLovin. I'm sure this company was named after that character. And AppLovin creates mobile apps. Essentially, they're like the
I think it's advertising. They help advertise on apps to drive more customers to their apps. Is what I was reading on their website. Let me back up a little bit. So as of April 2nd, Vistra was up 85%, NVIDIA's up 81%, AppLovin was up 75%. And I'll kind of rapid fire the rest of these. So Vertiv Holdings, don't know what they do. Shockwave Medical, I guess I can guess something there. MCore Group, Constellation Energy, Maple Bear, with a ticker symbol of CART, interesting. Williams-Sonoma, that's a company I recognize, up 54% year to date. And then Kava Group, up 53%. Interesting. Here's the best thing I see in this chart. Well, let me ask you, what's the best or what's the most promising thing that you see in this chart?
That it's not dominated by the Magnificent Seven from my point of view. The market caps for these outside of NVIDIA, the next biggest company is Constellation Energy Group, which kind of makes sense, right? The cost of energy has definitely gone up sharply with all the tensions across the globe. But yeah, these are pretty small to mid-sized companies.
Completely agree. Small caps are back. Hopefully they're back, right? After a number of years of not doing much. But yeah, NVIDIA, $2.25 trillion as of this print here. Constellation Energy, $60 billion. Still an S&P 500 company, but on the smaller side. And then the rest of these, $25 billion, $30 billion, $12 billion, $7 billion, $10 billion. So that's much more firmly. Technically, you can rank in the small and mid range in that. But that's much smaller. So I think that's interesting and good. And I think that's good to see.
Yeah. And I'd be careful looking at like the top best performers. There might be momentum, like if you look at this list to invest in, don't recommend it. I just, you're not going to get 100% returns just because it happened in the last
4 months.
4 months. Yeah. It happens.
Does happen.
Look at Supermicro as an example, but I think using any returns in your performance chasing, we don't have to look far to tell you that history doesn't really work out for that type of investment.
A couple of these show up on both the year to date and the last year. So this is like trailing 12 months as of April 2nd. So April 2nd, 2024, back to April 2nd, 2023. So Vertiv,
still
Vertiv was the best, actually. So there's no NVIDIA on this, by the way. Interesting.
No, it's on number 5.
Sorry. Okay, it's on number 5. At a whopping 222%. What are we doing? So Vertiv, 464%, AppLovin, 342%, XPO, that's a new one, 280%. Coinbase must have had a recovery there. And then Affirm, Vistra, Plantier Tech, Gap, and Williams-Sonoma. This is interesting because last year, it's a more mixed group, right? These are bigger companies, still skew smaller, but they're bigger companies here relative to what we're seeing in the year to date.
You want to go to 3 years?
Sure, let's do that, and then we'll wrap.
Yeah, NVIDIA's at top, 549%, pretty impressive. And again, that includes the 2022 sell-off where they were down 49%. People forget that, how volatile NVIDIA was. Next in line was Celsius Holdings, Builders First Source, Eli Lilly, thanks to Ozempic and weight loss drugs. Vistra Corp back on the top 5. Vertiv. Vistra or Vertiv, I can't differentiate the two. I can't remember. It's Vistra, who we're talking about.
Vertiv is the next one.
Yeah, Vertiv is the next one. Marathon Petroleum and Arista Networks. So over the last 3 years, as Chris points out in the last 1 year trail, pretty nice diversification in terms of top performers. And none of the Magnificent Seven outside of NVIDIA there.
And again, I would reiterate, NVIDIA is the biggest of the big here, $2.25 trillion. The next big one is Eli Lilly, $740 billion. All the rest of these are quite small, and so that's, again, this is much more normal. I think that many of us have been programmed the last handful of years that we can go buy the biggest of the big companies and expect a 30 to 50 or 100% return in a year. That's not normal and not healthy for such a big company to be priced that much higher. You have to move a lot of rocks to create $1 trillion of value. Much more common that a company swings to profitability or something, or sales increase, and all of a sudden you go from 1 to 10 billion type thing. So again, the healthiest thing I see here is these are much more normal sized companies instead of the big of the big.
Well, I think it proves one of the points that we made on the newsletter pod, where smaller companies tend, even if it's large, tend to overtake the top dog. Mm-hmm. And what the top dog has really in any industry is a big target on its back, whether it's from competition or from regulation. And I think NVIDIA, as Chris and I mentioned quite a few episodes ago, people are going to build chip foundries, or they're going to start developing chips that start to rival them. I can't see anything on the horizon, but I wouldn't be surprised in 2 or 3 years, we're talking about another NVIDIA, and we should have seen this coming, or something like that. It always happens.
This is wild. I just keep scrolling here. The last 5 years, Celsius Holdings. Who is that? They're up 5,300% in the last 5 years. NVIDIA, for context, is up 1,855%. That's the number 2 stock in the last 5 years, ending in April 2nd. This is ridiculous. Celsius Holdings is...
They're an energy drink.
Is that what they do?
Yeah. So we probably had a bunch of stock jockeys yelling at us, like, Chris, you should know this is an energy drink that my kids drink.
Fitness drinks.
18 a
supplement. You got to be kidding me. They're chasing Monster at this point. Okay,
Yeah.
so they have a $1 billion of revenue. The $1.3 billion of revenue, $200 million of earnings, and they're worth $15 billion. Okay, that's not crazy, but it's crazy that it's... Anyway, that's crazy. Tesla's in this list, a bunch of other AMD's in this list, a bunch of other companies that I've definitely never heard of. Best in the last 10 years, Celsius Holdings. 26,000%. That's not bad for 10 years. NVIDIA, 19,000%. AMD, 4,000%. Broadcom, Cadence Design Systems, Lam Research, Monolithic Power Systems, Axon Enterprise, that's the police camera company.
Yep.
They're up 1,500% in the last 10 years. It's not bad. Okay, 25 years. Let's just keep rolling here. Monster Beverage, thank you. Monster Beverage in the last 25 years, 138,000%.
Yeah, Kingmaker's there.
Deckers Outdoor Corp.
Yeah, they make Uggs. They make Uggs.
Wait, Uggs.
Uggs boots. The
Oh, thank you.
Yeah.
Thank you. When you said Uggs, I thought Crocs. I'm like, no, Crocs is publicly traded.
You got to get with the fashion times here.
I'm with the fashion, all right?
Yeah.
Look at what I'm wearing today. This is brand new Consilio swag, everybody. We got Consilio
Anyone who
right
sees us
here.
on video, it just screams like fashionistas, right?
I've got this. This is going to definitely improve my golf score. And I'm wearing Koto Paxi, which is a really trendy brand. And these are really nice, actually. Not actually, they are really nice. So, anyways, thanks for you reminding me of who made Uggs. You definitely are up on that type of stuff, so I appreciate you letting me know there. Okay, Deckers, NVIDIA, Apple, Old Dominion Freight Line, 45,000% in the last 20 years. Who would have held that stock for 25 years? Great. Clean Harbors, MVR, Texas, interesting. Well, I mean, that's as far back as we're going to go here, so that was fun.
I think the thing is, talk to anyone, see if they've held a stock for 25 years or more. One, does the stock even exist? So look how rare that is. Because NVIDIA at a time was trading at $1 per share, and people were wondering if they're going to be in business anymore. And this is like around 2010, 2011.
Yeah.
It's easier said than done after the fact. So I held a stock for 100,000% gain. I've never seen anyone physically hold that single stock and cashed in like that.
You know, the other thing that's interesting here is there are two massive companies on this 25-year list, NVIDIA and Apple. Those, of course, are the most obvious ones. Oh, yeah, I bought that 25 years ago, and it's worth, multiple trillions. I think it's important to note that you don't have to go buy the next $2.25 trillion company.
No.
So Deckers, which makes Uggs, as I'm now reminded, they're about a $20 billion company or so. Their return is, over 25 years, about double Apple's. Can you imagine that? It's double the return of Apple. It makes Ugg boots, not iPhones. It is double the return of Apple, and it makes Ugg boots, not iPhones. That's wild, right? It's also a higher return than NVIDIA. Now, NVIDIA's run-up has been in the last handful of years. And then the best of all of these has been Monster Beverage Company, $59 billion company. So I think the takeaway here is, you don't need to pick the next biggest company in the world to hit one of these. I know we're not talking about stock picking here, but I think that's, we all try to go find the next tech company. Might be the next beverage company. Might be the next medical company. Might be an oil company.
Yeah, there's mega trend that's happening
all
with
of
weight loss injections, right? The Ozempics.
exactly.
That could be.
Yeah.
Yeah, that could be. It already is monstrous, right? So something like that isn't so AI based. I think that's what Chris is saying, right? Just get a
Right. We all buy what we think is obvious, right? Oh, AI is going to take over the world. It's going to make all the money. So I'm going to go buy that. It's like, well, but what about a drug company? What about a beverage company? These are a clothing company for that matter, right? Ugg boots. So that's interesting. Okay, don't go out and go buy, Lululemon and Viore and stuff. But anyway,
well, unless you're buying to wear, not as an investment. Yeah. So no recommendations here.
Exactly. Okay, that was fun. All right, thanks everybody for tuning in today. And again, email us if you've ever sold a gold bar. I want to know how you did it, what you paid, and how that process worked, because I won't be the one to do that just for the purposes of the pod. So thanks for enlightening us. All right, everyone. We'll catch you in 2 weeks.
That was fun. Thank you.